January 27th, 2026. After 2 consecutive weeks of red across major indices, Wall Street just closed its first green week of the year. The S&P 500 up 2.8%, the Nasdaq up 3.4%, the Dow up 2.1%. Headlines are calling it a recovery, analysts are declaring the bottom is in, and retail investors are being told this is the dip to buy. But here's what nobody's showing you. The technical structure underneath this bounce is identical to 7 other failed rallies over the past 18 months. The volume profile shows institutional distribution, not accumulation. And the macroeconomic conditions that caused the sell-off haven't changed. They've actually gotten worse. In the next 30 minutes, I'm going to show you exactly what's happening beneath this recovery. The technical breakdown, revealing why this looks like a bear market rally. The institutional positioning data showing smart money is still selling. The macroeconomic catalysts that triggered the sell-off and why they're accelerating. And the historical patterns from 2000, 2008, and 2022 that match this exact setup. Because understanding whether this is genuine recovery or a dead cat bounce isn't about predictions. It's about pattern recognition. And the pattern says this bounce has maybe 2 to 4 weeks before the next leg down begins. Before analyzing the current bounce, you need to understand what happened in the 2 red weeks that preceded it. The sell-off wasn't random. 3 specific catalysts hit simultaneously in early January 2026. Catalyst 1 was the Federal Reserve pivot that wasn't. Throughout December 2025, markets priced in 3 rate cuts for 2026. Fed funds futures showed 87% probability of a cut at the January 29th meeting. Investors positioned accordingly. Then January 14th arrived. The December CPI report. Inflation came in at 3.4% year over year, up from 3.1% in November. Core inflation hit 3.9%, the highest since August 2025. Within 48 hours, Fed funds futures repriced completely. Probability of a January cut dropped from 87% to 12%. Probability of holding steady jumped to 71%. And suddenly, rate hike probability appeared at 17%. This was a complete reversal of the narrative supporting markets since October. The S&P fell 3.2% in 2 days. The Nasdaq fell 4.1%. That was just the beginning. Catalyst 2 was corporate earnings warnings. Q4 2025 earnings season began January 15th. Within the first week, 14 of the first 20 S&P 500 companies either missed estimates or issued weak guidance. JP Morgan Chase reported net interest income down 11% year over year. Guidance 8% below expectations. Goldman Sachs reported trading revenue down 18%. Bank of America showed credit card charge-offs up 23% year over year. Netflix missed subscriber additions by 2.1 million. Tesla delivered 410,000 vehicles versus estimates of 485,000. By January 20th, only 52% of companies were beating earnings estimates, the lowest start since Q2 2020. And earnings estimates for full year 2026 started getting revised downward. Analysts entered the year forecasting 11% earnings growth. As of January 26th, consensus fell to 9.3%. That's a 15% downward revision in 3 weeks. Catalyst 3 was China economic data. January 17th, China released Q4 2025 GDP at 4.6% year over year, below the 5% target and the weakest reading since Q2 2023. But the headline number only tells part of the story. The composition reveals deeper problems. Industrial production growth slowed to 5.3% from 6.8% in Q3. That's a significant deceleration in manufacturing activity, which is China's economic engine. Fixed asset investment, which includes infrastructure and real estate, grew only 3.8%, the slowest pace in 6 years. This matters because infrastructure investment has traditionally been China's go-to stimulus mechanism. When even government-directed investment is slowing, it signals profound weakness. Most alarming, retail sales growth decelerated to 3.2%, suggesting Chinese consumer spending is contracting in real terms after adjusting for inflation. This destroys the narrative that China is transitioning from export-driven to consumer-driven growth. If consumers aren't spending, the transition isn't happening. This matters for Wall Street because China is the world's second largest economy and the largest driver of global growth. When China slows, global growth slows, and global growth drives corporate earnings for multinational companies that make up the bulk of the S&P 500. The exposure runs deep. Apple generates approximately 19% of revenue from Greater China. When Chinese consumer spending weakens, iPhone sales fall. Tesla has similar exposure, with China representing roughly 22% of global deliveries. Starbucks derives significant revenue from China. The entire consumer discretionary sector has China exposure ranging from 15% to 35% of total revenue. So China's weak data meant analysts had to revise down earnings expectations for dozens of major companies simultaneously. And that's exactly what happened. Between January 17th and January 24th, analysts issued 142 earnings downgrades for S&P 500 companies citing China exposure. That compares to only 38 upgrades. The situation deteriorated further January 25th, when China's central bank, the PBOC, announced a surprise $500 billion yuan liquidity injection, approximately $70 billion, into the banking system. This emergency measure signals economic conditions are weaker than official data suggests. When central banks resort to emergency liquidity, they're essentially admitting the published GDP numbers don't tell the full story. For multinational companies, this creates a double problem. First, demand from Chinese consumers is weakening, hitting revenue. Second, Chinese competitors are becoming more aggressive in pricing compressed margins. Chinese electric vehicle manufacturers are cutting prices to maintain market share. Chinese smartphone makers are offering better specs at lower prices. This competitive pressure shows up in margin guidance from Western companies exposed to China. These three catalysts hit in 10 days. The market's response was predictable. The S&P fell 6.8% over 2 weeks. The Nasdaq fell 8.2%. The Russell 2000 fell 9.4%. The VIX jumped from 14.2 to 27.8. Then January 27th, the bounce. But none of the three catalysts have been resolved. Inflation remains elevated, Fed cuts are off the table, earnings are being revised down, China's economy is slowing. So why did markets bounce? Because markets always bounce. This is where technical analysis becomes critical. The S&P fell from 6,100 on January 13th to 5,685 on January 24th, a 6.8% decline. That 5,685 level is the 200-day moving average, one of the most watched technical indicators. Like when price touches it, markets typically bounce. But in bear markets, the first test always bounces, then markets retest, and the second test usually fails. In 2000, the Nasdaq first tested its 200-day moving average in July, bounced 18% over 4 weeks, then retested in September and crashed through, falling another 37%. In 2008, the S&P first tested in January, bounced 12% over 3 weeks, retested in March and crashed through, falling another 45%. In 2022, the S&P first tested in February, bounced 11% over 5 weeks, retested in May, and crashed through, falling another 18%. We just completed the first test January 24th. History suggests a bounce lasting 2 to 4 weeks, maybe into mid-February, then a retest. If that fails, the decline accelerates. Volume profile reveals who's controlling this market. During the 2 red weeks, average daily volume was 4.8 billion shares, 35% above the 50-day average. High volume on down days means institutional selling. During the bounce week, average volume was 3.2 billion shares, 15% below average. Low volume on up days means retail buying or short covering. This pattern, high volume down, low volume up, is a classic bear market signature. Institutions are selling, retail is buying. That's not sustainable. Market breadth measures participation. On January 27th, the S&P rose 2.8%, but only 62% of stocks closed higher. The Nasdaq rose 3.4%, but only 58% of stocks closed higher. The Russell 2000 rose 2.6%, but only 54% of small caps closed higher. Compare this to healthy rallies. October 2023 had 87% breadth, March 2024 had 82%. Strong rallies have 80% plus participation. This bounce has 60%, meaning it's driven by a handful of large cap stocks, primarily the Magnificent Seven. When they rally, the index rallies even if most stocks don't. This is distribution disguised as recovery. Momentum divergence shows weakness. The relative strength index on January 24th hit 28, oversold. By January 27th, it reached only 52. In October 2023, RSI reached 68 within 3 weeks. In March 2024, it reached 64. Strong bounces carry momentum to overbought territory. This bounce stalled at neutral. That means the rally is running out of energy. All 4 technical indicators point to the same conclusion. This is a bear market rally off oversold conditions. The underlying structure is weak. Institutional positioning reveals who's buying and who's selling. The Commitment of Traders report from January 24th shows large speculators reduced net long positions in S&P 500 futures by 42,000 contracts, a 23% reduction. Commercial hedgers increased short positions by 38,000 contracts. This divergence is bearish. Options flow over January 20th to 27th shows put-to-call ratio averaged 1.18. For every 100 calls bought, 118 puts were bought. When broken down by dollar volume, 68% of put buying came from institutional-sized orders over $500,000, and 71% of call buying came from retail-sized orders under $50,000. Institutions are buying protection. Retail is chasing upside, classic late-stage behavior, and institutions are buying far out of the money puts at strikes 15-20% below current levels with March and June expirations. These aren't hedges, these are directional bets on significant downside. Corporate insider transactions show insiders at S&P 500 companies sold $18.2 billion in January and bought $1.4 billion. That's a 13-to-1 sell-buy ratio. Normal is 3-to-1. The sectors with highest insider selling are technology, financials, and healthcare, the exact sectors leading the market. When insiders sell aggressively, business conditions are weakening. All positioning data points to the same conclusion. Smart money is defensive. This bounce is retail-driven, not institutional accumulation. Without institutional buying, rallies don't sustain. The three catalysts that caused the sell-off haven't resolved. They've worsened. The January 29th FOMC meeting is in 2 days. Current expectations show 71% probability of holding steady, 17% probability of hiking, only 12% probability of cutting. Fed Chair Powell said January 22nd, "We are not yet confident inflation is durably returning to 2%. Recent data suggests more work remains." That's hawkish. The Fed won't cut soon. Earnings guidance continues weakening. Of 127 companies that have reported Q4, only 53% beat estimates versus a 65% historical average. Of 82 companies issuing Q1 guidance, 71% guided below expectations. Full year 2026 estimates started at 11% growth, now at 9.3%. If revisions continue, estimates could fall to 7 to 8% by late February. The S&P trades at 20.8 times forward earnings versus a 16.5 historical average. For current prices to hold with falling earnings estimates, the multiple must expand, but multiples are already elevated. Without Fed cuts or improved sentiment, if earnings fall, prices must follow. China announced January 25th a surprise $500 billion yuan liquidity injection, $70 billion. Emergency liquidity signals economic conditions are weaker than official data suggests. If China needs aggressive stimulus for 4.6% growth, consumer demand is weak, meaning demand for Western products is weak, meaning multinational earnings will be weak. Historical precedents show this pattern repeating. In 2000, the Nasdaq fell 34% by May, bounced 38% by September. Analysts declared the bottom was in, the bounce failed. The Nasdaq fell another 60% over 18 months. Characteristics: oversold bounce, light volume on up days, weak breadth, concentration in large cap tech, weakening earnings. Sound familiar? In 2008, the S&P fell 9.8% in January, bounced 12% from March through May. Analysts called it recovery. The bounce failed. The S&P fell another 45% over 9 months. Characteristics: oversold bounce off support, lighter volume up, weak breadth, deteriorating economic data. Same pattern. In 2022, the S&P fell 17% through mid-March, bounced 11% by early April. Analysts said the correction was over. The bounce failed. The S&P fell another 16% over 6 months. Characteristics: oversold bounce, light volume, weak breadth, ongoing Fed tightening. Bear markets have multiple rallies lasting 3 to 8 weeks, retracing 30-50% of the prior decline, driven by oversold conditions. They fail when macro conditions don't improve. The current bounce has retraced 23% in 1 week. If patterns hold, this could last 2 to 3 more weeks, potentially pushing the S&P to 5,950 or 6,000. But unless inflation falls, earnings improve, and China stabilizes, this bounce will fail. What does this mean for positioning? We're likely mid-rally that could last 2 to 4 more weeks. Markets could recover another 5-7%. The S&P could reach 6,000. This is when retail buys, believing the bottom is in. But sophisticated investors are distributing into strength. Risk-reward is asymmetric. Buying at 5,845 offers maybe 3-5% upside versus 15-25% downside if the retest fails. You're risking $5 to make $1. Professional traders don't take that bet. They build cash, buy protection, and wait. After this bounce exhausts, probably mid-February, markets will retest 5,985. If they bounce on high volume with broad participation, maybe the correction is over. But if markets break below, it confirms a deeper bear market. Based on macro conditions, breakdown seems more probable. Sector positioning matters. Defensive sectors like consumer staples, utilities, and healthcare typically decline 30-40% less in bear markets. Growth sectors like technology and consumer discretionary fall 50-70% harder. If maintaining equity exposure, rotate to defense. Consider cash as a position. When stocks fall 30%, cash gains relative purchasing power. When markets reach attractive valuations, cash lets you deploy while others are forced to sell. Risk-reward is asymmetric. Buying at S&P 5,845 offers maybe 3 tours 5% upside to the bounce top versus 15-25% downside if the retest fails. Sophisticated investors don't take 4-to-1 risk-reward against them. They build cash, buy protection, and wait for better prices. Key dates over the next 90 days, January 29th, Fed meeting. If they signal openness to cuts, markets extend. If hawkish language persists, the rally ends. Watch Powell's press conference. Phrases like data-dependent leave the door open. Rates staying elevated until inflation reaches 2%, closes it. February 7th, January employment report. Below 100,000 jobs, signals recession risk. Above 200,000 gives the Fed justification to stay hawkish. Unemployment ticking from 4.1% to 4.3% or higher approaches. Somm rule recession trigger. February 14th to 28th, critical retest window. Watch S&P 5,685. Multiple tests indicate weakening support. A break on high volume confirms the retest failed. Next support 5 out of 400, then 5 out of 100, then 4,800. That's 18% downside from current levels. 3 scenarios with probabilities. Scenario 1, bullish. Markets rally to 6,200. Fed signals Q2 cuts, earnings stabilize. China announces major stimulus. Probability, 20%, requires multiple positive catalysts aligning simultaneously. Scenario 2, range bound. Markets bounce to 6,000, retest 5,685 holds. Trade in range for months as investors await clarity. Neither bulls nor bears get what they want. Probability, 30%. Scenario 3, bearish. Markets bounce to 5,950, retest 5,685, fails, break to 5,400 by March, then 5,100 by April, potential 4,800 by mid-2026. This requires Fed hawkishness, accelerating earnings revisions, or China deterioration. Probability, 50% based on historical patterns, current macro conditions, and defensive institutional positioning. When the most likely outcome is 15-25% downside, risk management becomes everything. This isn't about being bearish, it's about being probabilistic, and probabilities currently favor caution. Think about opportunity cost. Every dollar deployed now is unavailable when better opportunities emerge. If you buy at S&P 5,845 and the retest fails, you miss the chance to buy quality at 5 to 100. That's 15% better entry, which compounds dramatically over time. Warren Buffett said, "The stock market transfers money from the impatient to the patient. Right now, the impatient are buying this bounce. The patient are building cash, waiting for the retest to either confirm strength or create real bargains. Fear of missing out is powerful during bounces. Every up day makes you question your positioning." Social. Media fills with gain posts. Friends talk about recovering portfolios. The pressure to participate is intense. But discipline matters most here. Bear market rallies exist to trap late buyers. If you chase this rally and it fails at the retest, you've converted unrealized losses into realized losses. Better to endure FOMO and deploy when probabilities favor offense. What should you actually do? Not financial advice, but here's how institutions are thinking. First, reduce exposure during strength. If currently 80% equities, consider 50 to 60%. Use this bounce to lighten recovered positions. Second, liquidate weakest sectors. High valuation technology, consumer discretionary dependent on strong spending, financials with credit exposure. These typically lead markets lower. Third, maintain defensive exposure. Utilities, consumers, staples, healthcare decline 30 to 40% less in bear phases. Fourth, build cash to 30 to 40% by mid-February. Money markets earn 5% now. That beats losing 20% in declining equities. Fifth, consider hedging if you can't reduce equity exposure. Long-dated S&P 500 puts, inverse ETFs, VIX calls provide downside protection. Sixth, maintain discipline around the retest. Watch for high volume bounce, with broad participation versus breaking below on high volume. The next 90 days determine whether 2026 is consolidation or larger bear market. January was the warning. This bounce is the false signal. The retest is the revelation. Wall Street recovered after 2 red weeks. But recovery isn't reversal. Recovery is technical. Reversal is structural. This looks technical, not a fundamental improvement. The choice is about timing and risk management. When to play offense, when to defend. Right now, timing says wait. Risk reward says defend. Historical patterns say this: